What are the implications of farm loss rules for farm tax? Imagine running a farm and wondering how your losses can help reduce your tax bill. The rules around farm losses can seem tricky, but understanding them is key to managing your farm's finances. When you report farm income and expenses on Schedule F of your federal tax return, losses can sometimes be used to lower your overall taxable income. But there are rules to prevent people from claiming losses if their farm isn't truly a business. If your farm is considered a genuine business, losses from farming can usually be deducted against other income, like wages or investments. This can help lower your total tax bill. However, if your farm is classified as a hobby farm, meaning you're not trying to make a profit, your losses cannot be deducted from other income. The IRS looks at whether your farm has made a profit in at least 3 of the last 5 years. If it has, it's more likely to be considered a business. If not, they examine other factors like your intent to make a profit and how much time and money you invest. For part-time farmers who are relying on off-farm income, the rules can limit how much loss you can claim. For example, some tax laws cap deductible from losses at a certain amount, like $17,500. This means even if your actual losses are higher, you can only claim up to that limit. This can discourage farmers from using off-farm income to support their farming activities, especially for new or smaller farms. When you file your taxes, losses are reported on Schedule F. If your expenses exceed your income, you might generate a net operating loss. This loss can be carried back to previous years or forward to future years to offset taxable income, which can mean a quicker tax refund or less tax owed later. There are also special rules for losses from federally declared disasters. You can amend past returns to claim these losses, providing faster relief. For farmland investors and operators, understanding these rules is important because they influence how profitable your farm appears on paper. They also affect your ability to plan for succession and investment. Keeping detailed records and demonstrating your intent to run a profit can help ensure your losses are accepted as legitimate. Overall, farm loss rules aim to support genuine farming businesses while preventing abuse of loss deductions. Proper tax planning can help you make the most of these rules, keeping your farm financially healthy and compliant.